Welcome to the debate from GiltEdge.uk. Before we begin, this content is for informational purposes only and does not constitute financial advice. Always do your own research and consider seeking independent financial advice before making any investment decisions. Your capital is at risk. Today, The Guardian and the Challenger go head-to-head on premium bonds are still the safest bet in UK savings. Here's why risk-free savers should ignore the rate chasers. Let's get into it.
Premium bonds are the only savings product in the UK with 100% government backing, not just £85,000, but the full amount up to the £1 million limit. For anyone with serious savings, that alone makes them irreplaceable.
Irreplaceable? A cash I.S.A. paying 4.68% earns you £936 a year on 20 grand. Premium bonds at 3.3% give you roughly £660 on average. That's £276 you're leaving on the table, guaranteed.
Guaranteed? Nothing about a variable easy access rate is guaranteed. That 4.68% is a teaser, it could be cut next month with no notice.
And NS&I just cut the prize fund rate from 3.60% to 3.30% in April, so premium bonds aren't exactly immune to rate cuts either, are they?
Fair point, rates move everywhere. But here's what the rate chasers consistently get wrong: tax. A higher rate taxpayer earning 4.68% on savings outside an I.S.A. loses a chunk of that to income tax once they exceed their £500 personal savings allowance.
Which is exactly why I'm talking about a cash I.S.A., not a taxable savings account. Every penny of I.S.A. interest is tax-free, same as premium bonds. The tax argument is a red herring when you're comparing like with like.
It's not a red herring if you've already used your £20,000 I.S.A. allowance. Plenty of savers have more than that. Where does the rest go? Premium bonds let you hold up to £50,000 completely tax-free with no allowance to worry about.
Sure, for the portion above your I.S.A. allowance, premium bonds have a role. But most people haven't maxed out their I.S.A. The median UK savings pot is well under £20,000, so for the typical saver, this argument doesn't apply.
I'd push back on that. NS&I has over 21 million premium bond holders. These aren't all people with tiny pots. And there's a behavioral advantage nobody talks about: people actually leave their premium bonds alone. The monthly prize draw keeps them engaged without tempting them to withdraw.
That's exactly the problem. The lottery element is a psychological trick. It makes people feel like they're getting more than they are. You're essentially accepting a lower return in exchange for the excitement of maybe winning a prize.
Or you could call it a feature that stops people sabotaging their own savings. Behavioral finance research consistently shows that people who enjoy their savings vehicle stick with it longer. That compounding time matters more than a fraction of a percent.
A fraction of a percent? We're talking about 1.38 percentage points, 4.68% versus 3.3%. On £20,000, that's real money every single year. And with NS&I on a downward trajectory, that gap is only going to widen.
You're assuming the cash I.S.A. rate stays at 4.68%. History tells us those top-of-table rates get pulled fast. Meanwhile, NS&I tends to move more slowly and predictably because they're balancing government funding needs, not chasing deposits.
Even if the best I.S.A. rate drops to 4%, you're still earning significantly more than 3.3%. The gap would have to narrow to almost nothing before premium bonds make mathematical sense for a basic rate taxpayer with an unused I.S.A. allowance.
I'll grant you the maths for a basic rate taxpayer with a small pot and unused I.S.A. allowance. But you're ignoring the access question. Premium bonds give you genuine easy access, no notice period, no bonus rate you lose if you withdraw early.
Most of the top cash I.S.A.s are easy access too. That used to be a differentiator for premium bonds, but the market has caught up. You can withdraw from a flexible I.S.A. and replace the funds in the same tax year without losing your allowance.
True, but there's still the FSCS limit. If your bank goes under, you're covered for £85,000 per institution. With premium bonds, HM Treasury backs every penny. For anyone with more than £85,000 in savings, that's not a trivial distinction.
How many people have more than £85,000 sitting in a single savings account? And even if they do, you can spread it across multiple banks and get full FSCS protection on all of it at a much better rate.
You can, but managing 4 or 5 accounts to stay under FSCS limits at each bank is a hassle. One premium bond holding covers you up to £50,000 with zero counterparty risk. Simplicity has value.
Simplicity has value, but £276 a year has more value. And that's on just £20,000. Scale it up and the opportunity cost gets painful. At £50,000, you're potentially giving up nearly £700 a year for the comfort of a simpler setup.
You keep using the average expected return as though it's what every bondholder gets. Some win more, some win less. But the median holder of a decent-sized pot does tend to get close to the headline rate over time.
And some win nothing at all in a given month. That's the point, it's variable by design. A cash I.S.A. pays you exactly what it says it will. There's no luck involved, no variance, no crossing your fingers on prize draw day.
Look, I'm not saying premium bonds are right for everyone. But for higher-rate taxpayers, for anyone with savings above the I.S.A. allowance, and for people who value the government guarantee, they're still the safest, smartest place for a significant portion of your cash.
And I'm not saying they're worthless. But the default position for most UK savers should be to max out their cash I.S.A. first, earn the higher guaranteed return, and only then consider premium bonds for anything above that.
We probably agree more than we disagree. It's about the order of operations and your personal tax situation. My concern is people reflexively dumping premium bonds because a headline told them to chase a rate that might not last.
And my concern is people holding £20,000 in premium bonds earning 3.3% when they haven't even opened a cash I.S.A. The rate cut to 3.3% should be the wake-up call to at least do the maths on your own situation.
In a world of bank failures, platform outages, and disappearing bonus rates, the certainty that your money is backed by the full faith of HM Treasury is worth more than people realize, until they need it.
And in the real world where most people's savings are well under the FSCS limit, a cash I.S.A. paying 4.68% tax-free beats a 3.3% average with a lottery attached, and that's not even close.
The Guardian, The Challenger, thank you both. What do you think? Let us know in the comments. Read both articles in full at gilt-edge.uk. Thanks for listening to the debate.